Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Here we got financial reporting standards. Once again, in my opinion, it's kind of a filler module. We'll go through it pretty quick. Like quick side note, I think when I wrote level one, this module and the last one were combined. I guess they separated it just to, I don't know, enhance readability maybe, but like I said, this module is very high level. It doesn't really go into a lot of depth, so we'll go through it quick, kind of just fly through it. But regardless, the key two topics are characteristics of financial reports. So we'll go over the two fundamental characteristics that are present in financial reports, and then four enhancing characteristics that could make, financial reporting better for the end user. And then really briefly, we're going to touch on different measurement methods and in particular ways to value assets on the balance sheet. A couple that we'll touch on are historical cost, realizable value, and so on. This module just gives the definition of these measurement methods, whereas once we actually get into the heat of things, we're going to need to know how to calculate them, the different impact that they have on the income statement, balance sheet, cash flow statement, etc. But anyway, we'll go through this one really quickly, so let's just get into it. According to the conceptual framework for financial reporting, which of the following is not an enhancing qualitative characteristic of information in financial statements? Well, the four characteristics are comparability, which basically says that information is consistent across time periods. Verifiability, which basically says that, um, if an independent observer had the same input information, they could obtain the same results. Timeliness, so, pretty self-explanatory. The financial statements are reported on time. So if you have a quarterly report, it's not being released like 2 quarters later. And then understandability, which basically says that someone with relatively basic finance knowledge can understand the report. So, they can't be presented in a way that are too complex. There has to be some structure to them. So just looking at this list, which one is not on here? And it is accuracy, which is pretty interesting. Um, like quick side note, accuracy, I guess it's a bit subjective. With the accounting standards, there is some leeway in terms of what companies can report. And like different accounting standards, which is something you'll see a little bit later, will result in slightly different results. Um, kind of funny thing actually. I had a accounting course when I was in university, and my prof there was he had a lot of industry experience. I think he worked at the Big Four for like 30 years or something, and then he became a prof. But he said that the only true thing on a financial statement is the title. Funny enough, um, and he's been doing it for years and years and years. So it just kind of shows how you have to be careful when reading financial statements because there are a lot of underlying assumptions that go into them, and an analyst's job is to, understand the assumptions and be able to make good decisions based on that. The assumption that the effects of transactions and other events are recognized when they occur, not when the cash flows occur, is called accrual basis. And this is something, once again, we'll dive into a little bit in more of the detailed modules, but the whole idea is that um, statements are not provided on a cash basis. Their, revenue and expenses are recognized when services are recognized. So as a real easy example, let's say someone like a customer prepays a company for a product. That cash that the company receives isn't technically revenue, it's unearned revenue, which is a liability to the company. And then once they eventually provide the goods and the services, they can, take the liability as essentially debit, the unearned revenue account and credit revenue, which that would be like the offsetting transaction. But basically, like the liability becomes actual revenue once the services are provided. Moving on, neutrality of information in the financial statements most closely contributes to which qualitative characteristics. So there's actually two fundamental characteristics of financial reports as well, and they are relevance and faithful representation. And these are the fundamental, so fundamental characteristics. The ones we went over earlier were enhancing characteristics, but these two are determined to be fundamental and relevance. You know, once again, pretty self-explanatory. Just the information that the companies are providing are relevant to investment decisions. It's not, they're not just providing some random info on stuff that doesn't matter. And then faithful representation is, obviously not engaging in fraudulent accounting and making sure that what you're presenting is actually representative of the underlying health of the company. So coming back to the question, neutrality of information most closely contributes to which qualitative characteristics? Relevance, not really. Understand, really, like it's kind of a toss up between these two, but it's faithful representation. And once again, this is the key word here is neutrality. So they're not, taking any biased accounting choices when they're preparing their financial statements. Valuing assets at the amount of cash or cash equivalents paid or the fair value of the consideration given to acquire them at the time of acquisition most closely describes which measurement of financial statement elements. And this would be historical cost. So if they're measuring, let's say PP&E at the cash or fair value to acquire them at the time of acquisition, this is historical, right? So it's like they're reporting it on their balance sheet at the cost it took them to acquire it, and then from there, over the years they would depreciate it using some methods, which we'll describe a little bit later. Moving on, the valuation technique under which assets are recorded at the amount that would be received in an orderly disposal. So if they were selling them, this is realizable value, which essentially is, the cost. The realizable value would be the cash inflow for receiving them minus if there's any outflows associated with the sale. This would be accounted for as well, but it's basically the net cash in that they would get from a sale. And there is a bit of judgment that the companies can make in terms of like a fair value that they can get from an orderly disposal. It's they can't just make up some random number. It has to be either based on off like historical transactions for a similar asset in the market, or if there's like an active market for the asset, then they'll use that price, or stuff like that. They can't just kind of inflate the value of their assets by making this number up. There has to be some justification behind it. Last couple really quickly. Which of the following elements of financial statements is most closely related to measurement of performance? So performance, also known as profitability. So out of the three, expenses would be the most relevant 'cause this is on the income statement. Assets and liabilities don't, I mean, the way they're phrasing it, it's, wouldn't really hold up in the industry. Of course, everything's important. Like assets and liabilities are of course important, but I guess their thinking is that assets and liabilities are more related to the capital structure of the company instead of their profitability or day-to-day performance. And then last one, which of the following elements of financial statements is most closely related to measurement of financial position? So this is the opposite of what we just did in question 12. Income and expenses are profitability, so financial position would be equity, which is on the balance sheet, as well as assets and liabilities.